Hey, here's your quick breakdown of this week's biggest economic stories. From June 30th to July 5th, jobs are up, but not as they seem. The Fed's still on hold. A new mega bill fuels the deficit. Tariffs return, and China's slowdown is rippling worldwide. Let's get into it. One, U.S. jobs report and the Fed. Let's start with the big one. The June jobs report. The U.S. economy added 147,000 jobs last month, stronger than expected. The unemployment rate ticked down to 4.1%. Sounds like good news, right? Well, not entirely. The private sector, according to ADP data, actually lost 33,000 jobs. That's the first significant drop in private employment in nearly 2 years. The strength in the report came mostly from government hiring, especially in healthcare and local administration. Why does this matter? Because everyone's watching the Fed. With inflation still above target and mixed signals in the labor market, hopes for a July interest rate cut just got crushed. Market expectations for a July cut fell to around 6%, while odds for a September cut sit closer to 70%. There's growing deficit. Now to Capitol Hill. This week, the U.S. House passed what many are calling the mega bill, a massive tax and spending package that cuts taxes, boosts military and border enforcement, and slashes funding for social programs and green initiatives. The Congressional Budget Office estimates the bill will increase the federal deficit by around $3.4 trillion over the next decade. And here's where it gets interesting. To finance this ballooning deficit, the Treasury is leaning hard on short-term borrowing, Treasury bills, not long bonds. That's right, expect a wave of short-term debt auctions, with yields rising above 4%. This shift could push short-term interest rates even higher, tighten liquidity in the markets, and put more pressure on the Fed. 3. Trade tensions are back. The 90-day tariff pause expired this week, and the U.S. administration began notifying countries of new reciprocal tariffs, ranging from 10% to as high as 70%. These tariffs will start taking effect on July 9th and begin collection on August 1st. This comes as part of a broader shift toward aggressive trade policy aimed at correcting long-standing imbalances. Some countries, like the UK, China, and Vietnam, managed to sign new trade agreements just in time. Others, like Japan and South Korea, are still in stalled negotiations. But here's the kicker. Small and mid-sized U.S. businesses are expected to face an additional $80 billion in costs due to these tariffs. And you guessed it, those costs will be passed on to consumers. 4. Inflation and housing. Speaking of inflation, the latest data shows it's not gone yet. The Fed's preferred measure, the Personal Consumption Expenditures Index, or PCE, rose 2.3% year-over-year in May. That's up slightly from April's 2.2%. The breakdown? Goods are nearly flat, but services, things like rent, insurance, and healthcare, are still climbing, up 3.4%. And what about housing? Home prices across the top 20 U.S. Metro areas dipped about 0.3% in April. It's a small drop, but it shows that high mortgage rates are finally cooling the market. So yes, inflation is slowing, but not fast enough to trigger immediate Fed action. And housing remains tight, especially for first-time buyers. 5. America's trade deficit grows. Let's talk about trade again, this time from the U.S. side. The American current account deficit grew to over $450 billion in Q1 2025. That's about 6% of GDP. That's a sharp rise from the previous quarter, and it's largely due to a wider goods deficit and a shrinking surplus in services. Put simply, the U.S. is importing way more than it exports, and that's putting additional pressure on the dollar and on long-term sustainability. America's net international investment position, which compares what we own abroad to what we owe, sits at around negative $24.6 trillion. That's not a typo. We owe the world almost $25 trillion more than it owes us. 6. China's economy. More trouble brewing now. Let's turn to China. Their manufacturing sector shrank again in June, the third straight month of contraction. The official PMI came in below 50, indicating the sector is still in decline. Weak exports, oversupply, and a struggling property sector are all dragging things down. In response, the Chinese Communist Party issued new guidelines calling for a crackdown on price wars, overcapacity, and destructive competition. That's a big sign they're preparing for deeper structural reforms, or even bailouts, in key sectors. Meanwhile, China and the US agreed to reduce tariffs on certain categories of goods, at least temporarily. If China stimulates its economy again, we could see a short-term boost in demand, but also rising global inflation risks. 7. Geopolitical risk and global events. We can't talk economics without looking at geopolitics. In the Middle East, the Israel-Gaza conflict escalated again this week, with dozens killed in a new round of airstrikes. This adds to regional instability and could influence global oil prices if tensions expand. Meanwhile, in Bangladesh, a nationwide strike by tax officials disrupted customs operations at major ports, causing severe delays in global supply chains. The government had to intervene to restore order. And in Asia, China lifted its seafood ban on Japan, a minor but symbolically important move that could ease regional tensions slightly. All of these developments might seem far from home, but they have real economic consequences, from energy prices and supply chain disruptions to markets, the dollar and oil. Now, let's wrap up with the markets. U.S. stocks reached new record highs this week, buoyed by a stronger-than-expected jobs report and optimism that inflation is slowly being tamed. Bond yields also jumped, especially on the short end, reflecting both strong demand for Treasury bills and fading hopes of a near-term Fed rate cut. The U.S. dollar gained strength, making American exports more expensive abroad, but helping to ease import prices slightly. And oil prices dipped, thanks to higher-than-expected inventories and easing tensions in some oil-producing regions. It's a mixed picture, but for now, markets remain bullish, betting on a soft landing for the economy. So what should we watch for next week? Keep an eye on new jobless claims, which could signal whether the private labor market is weakening. Also, expect new global PMI data, especially from Europe and Asia, which will offer clues about global manufacturing momentum. The European Central Bank will also release flash inflation data, and Fed Chair Powell is scheduled for another public appearance. His tone could influence markets even more than the numbers.